Good morning, everyone. My name is Brian Walsh. I'm head of impact at the fintech company LiquidNet. I'm also the host of the Returns on Investment podcast from Impact Alpha. And my co-host, one of my co-hosts, along with David Bank, is Imogen Rose Smith, who is one of the organizers of this event, and you'll hear from her later today, I believe. But we have a great panel for you. So you have their bios on the website, you have access to them, so we won't do the full bios, but we have Dana, who's the president of the Heron Foundation here. We have Mike, who is a director with the Rockefeller Foundation on their innovative finance team, and we have Kate, who's with New Access Energy. And I want to start by asking you each, and going down the line, starting with Dana, to explain the purpose of your organization.
Yeah. So the mission, which is related to the purpose, the mission is to help people and communities to help themselves. But I would say our purpose really is around embodying every single form of capital we have as a foundation, which necessarily operates in privilege, using every form of capital, not just financial, in service to that mission. So our social capital, our connections, our relationships, our convening power, in addition to financial capital.
Great.
Yeah, so the mission of the Rockefeller Foundation, which has remained unchanged since our founding in 1913, is to improve the well-being of humanity throughout the world. I don't often get asked to quote that mission statement, so I'm glad I got it right. And so we do that, as Dana mentioned, by leveraging our convening power, our brand, our flexible funding. We're focused on kind of 4 key sectors, as most foundations have kind of the key priority areas. For us, that's health, food, power, climate, and then my team, Innovative Finance, and kind of data and technology kind of cross-cut across those sectors and support those different programmatic strategies achieve their broader programmatic goals.
New Energy Nexus is a global nonprofit, so I'm the one operator up here. Our mission is to create 100% clean energy for 100% of the population. And we're working to build the clean energy economy by investing in a diverse and wide range of clean energy entrepreneurs through funds, accelerators, and networks. We started in California and are now working all over Southeast Asia and just started in Africa.
That's great. And so the goal or the purpose of this conversation, this panel today, is to talk about catalyzing capital for change, which I love the rest of the title, and you see this in the programs, Building Tomorrow Today. It's better than building yesterday tomorrow, or something like that. So I think we're on the good kind of directional path there. But there's this notion that we have trillions of dollars of capital in the traditional commercial capital markets. We have perhaps hundreds of billions of dollars of capital in foundations, in impact investment funds, in development finance institutions and the like. And then we have millions, if not billions, of dollars of capital for philanthropic grants from US government and other developed country government agencies, development agencies, from foundations like the 2 that you represent, and from millions, if not billions, of individuals. So if we think about the millions and billions in philanthropic capital, the billions in development finance and impact capital, sometimes called catalytic capital, and then the trillions in the traditional commercial capital markets. How do we get the trillions activated alongside the philanthropic capital and the catalytic capital? So why is there still capital sitting on the sidelines from the impact conversation? Dana.
I was hoping you weren't going to start with me. First of all, with all those illions, I feel like I need to be going millions. But a couple of things, I think, from Heron's perspective, and like many of you, I've been in the field, embarrassingly, almost 30 years at this point, in one form or another. And if I'm honest, I get really frustrated by each of us who has our specific thing that we do, and it makes catalyzing the capital really difficult. And when you're coming to investment, if you're moving into investment from philanthropists, it's our training, not an indictment, but our training to state very clearly what we will do, which makes partnership, collaboration, and scale really, really hard. And so if I'm honest, and I want to say like Chatham House rules, but that's kind of hard with a hashtag and trending and things like that. Yeah, I know, hi camera with the big red light. If I'm honest, I put less time and effort into catalyzing my philanthropic colleagues these days, quote, as though we could catalyze each other, but I put less time into that and more time into working with traditional capital markets functions. And so I know it's probably never been said before, but we're working on catalyzing fixed income, catalyzing municipal debt, and instruments that already operate at scale, we're just replumbing them so that they're responsive to community demand and community voice in a way that they should have been originally and have since become separated. So we spend a lot of time in our shop talking about catalyzing existing market tools in service to a community's demands and needs, and I can give examples later.
And so for those of you in the audience who had muni debt on your High Water Women bingo card, you're in luck. That was a great plug right there. So from your perspective, Mike, is there capital sitting on the sidelines?
Well, yes, I mean, absolutely. We know there is, and we hear endless amounts about the SDG financing gap, which we've all been focused on trying to overcome with our various programs. Before I get into that, I will disagree with Dana. I mean, I was shocked. So I joined the Rockefeller Foundation about 2 years ago, and it was pretty darn surprising how little the foundations in the philanthropy world kind of co-invested and worked together on different partnerships. And so I think we've been working at the Rockefeller Foundation with some of our peers to try to overcome that. And so we're in kind of the midst of a strategic reboot within the foundation, within our innovative finance portfolio specifically, where we're trying to overcome the issues around catalytic capital. And when I say catalytic capital, just so we're all on the same page, I'm talking about capital that is risk tolerant, it's patient, yes, at times it's concessional, but not always. And the issues and the market failures with catalytic capital are really threefold. It's scarce, it's difficult to access. If you're a private sector player out there, you don't really know where to go to interact with groups like the Rockefeller Foundation, even though it's pretty obvious via the website. And three, it's poorly leveraged. We're not leveraging our catalytic resources as sufficiently and efficiently as we can. And so we recently launched a platform within the foundation called Impact Investment Management, which I can go into more detail, but it's really around the idea of bringing some scale and efficiency to this world of catalytic capital and finding ways to crowd in our catalytic capital providing partners into transactions, be them direct deals, funds, co-creating new investment structures, all with an eye towards mobilizing private capital, the trillions that are on the sidelines at the end of the day, but doing so in partnership and at scale that will actually move the needle on that financing gap, as opposed to just continuing to do small bespoke things with our head down in our defined lanes.
Now, Kate, New Energy Nexus works as a nonprofit, but works with clean energy entrepreneurs. Do you think that there is capital sitting on the sidelines? And what are the challenges that you see the entrepreneurs that you work with across your global network that they face in accessing capital?
Sure, and I should say that I'm actually new to this world. I've spent most of my career as a serial entrepreneur in the private sector. Decided within the past year to focus myself on climate-related issues just because it's the issues that's going to envelop everything, and thought I could do some good here. And so I can speak to both what I saw as an entrepreneur with mission-focused businesses and to what my colleagues and I now see. Most of our work is the first money in. And in that respect, we're trying to create vehicles for people to invest in, not vehicles, companies for people to invest in where there's a gap, where other money doesn't exist. And I think that a lot of money doesn't go there because it's too risky. And I think that even money that's oriented towards impact is often overburdened. The diligence process is too complicated. The deals themselves are too complicated. If you're an entrepreneur, and in most cases you can only absorb $50,000 to $100,000 worth of investment, you can't spend a significant portion of that on fees. And if you wait too long, we had a vehicle in India that we watched, I guess it was something like $3.5 million investment. And in the time it took to negotiate the terms and do the diligence, the underlying conditions had changed, and now the money's on the sideline because it just wasn't, the approach wasn't structured to move quickly enough. And so I think that that's one of the reasons why capital sits on the sidelines. A lot more to say about why it sits on the sidelines and just pure business investing, even up the chain at the VC level and beyond. And I think that's largely because the investment theses in private capital are very narrow, focused on the biggest returns at the end of the spectrum. If you're not AI, if you're not, the thing that people think is now going to have the fastest, highest hockey stick, there's a huge space left. And I'll also say, as somebody who is incredibly privileged, having gone to even Harvard and Stanford myself, getting into those networks is very hard. You have to work very hard to tap into the traditional business networks, which is a introduction-based world. And so part of what we're trying to do with our accelerator programs is broaden that and make it a more inclusive process.
Dana, Heron was one of the first foundations to say that they were going to think about their capital not as we have an endowment over here that tries to maximize financial returns so that we can pay out 5% every year legally required by the IRS in the form of grants to nonprofits. And that's the traditional model of a foundation. You have the investment team that does the investments. You have a program officer team that does the grant making, and never the two shall meet. And don't ask the investment team any questions about their strategies or their impact or the negative externalities that are being generated through those investments. Just hope for good returns so that the program team can continue to do good grant-making work. Now, so you've at the Heron is one of the trailblazers in trying to kind of move beyond that bifurcated world of philanthropy. What was the hardest transition that the foundation had to make in thinking about, putting 100% of assets aligned with mission?
Yeah. So we get asked that question a lot, and a lot of people want to know how we got our trustees there. And the reality was, if I'm honest, that was just never our fight. Our trustees have always been leading and pushing from the outset, saying this business model is ridiculousness. The idea that somebody somewhere, no matter how a foundation gets formed, somebody took a tax deduction for forming it. The presumption being the money would work in service to society. And yet, regulatorily, if that's a word, only 5% is actually called to be in service. And my board has always felt that that was illogical, it was wasteful, and it was just further evidence of privilege. So I think the hardest transition and by the way, if we're honest, it's not 5%. It's required to be 5%, but at the end of the day, qualifying administrative expenses are deducted from that. So if we're honest, it's less than 5% that's actually working in service. And so for us, I think the hardest job was trying to overcome what is, quote, best practice. We internally talk a fair amount about best bad practice, because best practice was, it was progress, but quoting Maya Angelou, we did then what we knew how to do, and when we knew better, we did better. The field started with program-related investment, which was the right thing to do, but over time, our board started saying, you know what, it's good to add positions that are impactful. That's the right thing to do. But we can't disavow that we're an asset owner. We are. We're not starting with cash. We have existing positions. We really need to examine to understand what's knowable, and data's terrible and imperfect, but we need to know what's knowable about the impact of our existing portfolio. And that was a big hurdle for us to say, yep, that's an undertaking worth doing, instead of just saying, here's a great deal, let's add it. We needed to do both, and the two needed to meet in the middle. And that was ugly, and we learned a lot, and we stubbed our toe a ton, but it was probably the hardest thing, which then accelerated us most quickly.
Now, Mike, you quoted the founding mission of the Rockefeller Foundation, which has been around for over 100 years. And it's not typical for a private foundation in the US to create its own capital management company. Can you talk to us a little bit more in depth about what drove the creation of this and what you've learned early on?
Sure, no, absolutely. So as I mentioned earlier, we recently created this new entity called Impact Investment Management, which at its core is looks, smells, and feels like a traditional asset management company. So it reports to the SEC. It is forced to require all the same disclosure and kind of regulatory guidelines as any other asset manager would. What makes it unique, as Brian mentioned, is that it's wholly owned by the Rockefeller Foundation, and it is controlled by the programmatic side of the house, so not our kind of endowment investing team per the prior conversation. And really the impetus behind creating this asset management platform within the foundation was, and to their credit, was the MacArthur Foundation committing a slug of their own money, again, getting to this partnership point, to a program that we were running, which we called the Zero Gap program, which is all around creating new financial products and mechanisms that can mobilize large-scale private, so institutional and retail capital against the SDGs. And so as we started investing against this Zero Gap mandate, MacArthur basically said, look, we love what you guys are doing. How can we get involved? And as a part of their broader Catalytic Capital consortium, we ended up partnering where they gave us a slug of their money to invest alongside of our own. And so in doing so, we were forced to create this new platform, which 10 months later, we now realize has opened up all sorts of different doors for us in terms of how we can use this platform differently to move the space along in a more efficient way. And basically, we think we can do that through 3 different kind of service lines. One is managing money. So if and when it makes sense, we will manage money. We will aggregate catalytic capital on the platform that our team will invest. 2 is we'll kind of co-create dedicated investment structures, again, with partners on the catalytic capital side when we feel like we have the rationale or the market gap to do so. And so there's an example there around resilient infrastructure that I can go into later. And then third, we can use the platform to syndicate kind of large-scale impact transactions. And so these are transactions that for whatever reason we are privy to that are coming through our pipeline that we simply can't do on our own. And so an example there is we're working on a $1 billion kind of mini-grid project in India, which if it goes through will by far be the largest mini-grid project in the world. And we can't possibly fund the catalytic capital requirement in that transaction. So we'll use this platform to actually bring people into the mix and basically use our deal flow and our platform to bring others into the picture. We're doing all this at a low to no fee type arrangement. Lots of growing pains, I guess, as Dana mentioned, in terms of her mission-driven focus. For us, kind of creating this platform, while we've invested in tons of funds and we've invested in a lot of direct transactions, it's not until you create your own fund and really understand the intricacies of what that entails that you kind of learn all those tough lessons. I'll say one thing that was incredibly impactful in creating the platform, and this goes to Dana's last point about kind of the traditional model of having the endowment team and the program team, is we had our endowment team intimately involved in kind of creating the mechanism, helping us with their expertise and their learnings. Our chief investment officer on the endowment side is actually the head of our investment committee in this asset management platform. So we're able to bring her learnings and credibility into the fold. So it's not quite the progress that Dana and her team have made that she deserves a lot of credit for, but we're kind of breaking down some of those silos in our own kind of way through this unique platform.
And just a quick clarifying, so the $30 million of capital that came from Rockefeller to this investment management and the $30 million of capital that came from MacArthur for it, was that both from the grant pools of capital?
It was. So it's all PRI money. So at the moment, everything that this IAM Impact Investment Management platform does will be PRI focused.
Got it. Okay. Now, Kate, can you talk about the business model of your organization as a nonprofit and the types of capital that you have access to and the types of capital that you try to activate on behalf of your entrepreneurs that you work with?
Sure, and maybe start with a tiny bit of history about the organization. Interestingly, we started in 2004 as a result of the first PG&E bankruptcy, where $30 million was to be deployed under the banner of the California Clean Energy Fund. And so the mandate of the organization at the time, the California Clean Energy Fund, was to help really seed the foundation for the clean energy innovation infrastructure in California. They invested in about 150 companies, most of which nobody else would touch at the time. One was named Tesla. We know where that went, and many you've never heard of and never will. But there was an incredibly deep and rich set of learnings through that experience of more than 10 years. And over time, one of the big lessons was the importance of building an overall ecosystem that brought in lots of different kinds of money, not just state money and ratepayer money, which I can talk more about, but also philanthropy, and we found ways of stacking those. Within the past few years, we decided that the climate crisis required us to leverage that experience, those lessons, those know-hows, the networks, to go to the front lines of the climate crisis. And so we now have offices in Indonesia, the Philippines, Vietnam, China, Uganda now, and I'm leading the effort in New York, which is sort of the polar opposite of most of the work we do. And the most typical of our work is what we're doing in Indonesia, where that's actually fully funded by the IKEA Foundation, who gave us a $10 million grant over 3 years to both put in place a series of accelerators that basically fund, support, and network entrepreneurs with the resources they need, and a fund. We have a $4 million vehicle now in place, and kind of shockingly for a country of 300 million people, that's the largest clean energy early stage investment vehicle in the country.
Wow, that's incredible. Mike, you mentioned, referenced earlier the SDG financing gap, right? So for those who don't know or aren't familiar, I'm sure this room is well versed, but just in case, the Sustainable Development Goals, the SDGs, are global goals passed by the UN General Assembly back in 2015, and they're a set of 17 aspirations and commitments for a more environmentally sustainable, socially inclusive world by the year 2030. And the UN did a report, and they calculated that it's going to cost about $4 trillion with a T dollars every year until 2030 to start to tackle these goals at scale. And if you add up all the money from governments and foundations and money that's already accounted for going towards these, there's still a $2.5 trillion gap. And so all the philanthropy in the world, a lot of the government money allocated for these kinds of things in the world is not enough. And so, that famous line about the bank robber, why did he rob banks? Because that's where the money is. So a lot of people have turned to the capital markets and saying, how can we activate the capital markets? And Dana, I want to start with you, because I thought you said something interesting about Heron's evolution, where you, not that you don't get involved with conversations with other funders and other foundations, but you're no longer really just trying to convince them. You're trying to work more squarely with the capital markets. So tell me about where you see the most opportunity in leveraging what your foundation has access to, which is your connections, your flexible capital, your grant capital, and activating more of the kind of commercial private sector capital. So how do you, and what are the challenges in demonstrating credibility to those purely commercial investors that you are trying to engage?
Sure. Well, I'd love to tell you that this was a grand strategy that succeeded for us. It really wasn't. It just fell out of the learnings from working in places. And so I think for us, I would describe a couple of things. When you've combined your programmatic and your investment sides, everybody has a little bit of both. To be clear, we're generalists, and we pull in the specific expertise that we need when we need it. But that said, it would happen again and again and again that we'd be working in a community, and affordable housing is an issue. And as philanthropists, what we often know how to do really well is build really complex capital stacks to make sure capital is cheap so that we can help launch some affordable housing or LIHTC or pick your favorite need in a community. But as investor, since you're working on both pieces at Heron, as investor, we would say all day long, you know what, we're buying mortgage rev bonds constantly, or we're buying pools of mortgage-backed securities. Do any of those come from this place? Because that was a natural instinct when your programmatic and your investment side are combined. And the reality was they often didn't. And so it's baby steps, right? There's value in incrementalism. So in the early days, we would say, hey, can we zip code our mortgage-backed security pools to try and create demand to say we really want all of our pools and our normal market rate fixed income accounts to come from that place? Because remember, we're small. And on any given day, we may have 100 million in market rate fixed income. And if you take 5% of 300 million, that's a much smaller number. So where's our impact coming from? And then we would learn things like, just recently working with a community in California, they're developing a housing fund with a bunch of philanthropies. And we sat with their HFA, their Housing Finance Authority, and said, you guys have a great CAFR, forgive me for nerding out, Comprehensive Annual Financial statement. And you have
That's on the bingo card as well.
I'm just full of them today. You know, you have a great S&P rating and you haven't issued mortgage rev bonds in more than 12 years, but your community voice is saying housing's your primary concern. Help me understand the disconnect as philanthropist, as investor. And after building a lot of trust with the HFA, they said, well, we don't know how. The person who did that left. Mm-hmm. That's a great role, because you can jump in as philanthropist and provide some technical assistance and hold their hand while they get an investment banker. And as a mission-motivated investor, we can be standby buyer for that first issuance just to grease the skids of a normal, existing capital markets function. And the reality is their second issuance is off and running. They don't need us. We're irrelevant, and that's victory to us. And so when I say we spend less time focused on our philanthropic colleagues, it's not because all of the philanthropies aren't wonderful. They are. And my coaches taught me I can't say but, I have to say and.
Yes.
And.
Yes, and.
Yes, and. When we're all driven by such specificity on the program side, it is exhausting, like whole other conversation, personally exhausting to have those conversations repeatedly. And part of me is like, you know what, let's just jump the fence and get the affordable housing done, because from a purpose place, that's what we're called to do. And then when we have recharged, we will return to the conversations with our philanthropic colleagues and always try to bring that back together. But sometimes the markets are more efficient.
Yeah, and on that efficient markets piece, I do think that, and just broadly speaking of the three pools of capital, there's almost an inverse relationship. So the philanthropic capital, which is 100% concessional, right? No returns needed on one hand. On the fully commercial capital, you know, trying to get rich adjusted returns with no concern about impact. And then in between this impact investing, our catalytic capital pool, which is trying to activate for impact and trying to activate for returns. On the fully commercial capital side, there are no strings attached, no impact strings attached, right? On the philanthropic capital, there are strong strings attached. That capital can only go into certain areas with certain conditions and in certain sizes. And then in between this catalytic or impact capital, it's a little bit more flexible, but there's still some strings. And so it's, as you get to the larger check sizes, you get fewer impact strings. But that's in some ways the, you know, commercial capital will go where it's treated best. Mm-hmm. And as long as we can put together structures and deals that treats commercial capital well, mm-hmm. Then that money will flow. The challenge is trying to activate and mobilize the pools of philanthropic capital and catalytic capital, mobilizing them to then attract the commercial capital. So
yeah, well, and just because I see Anna sitting there, and for many of you, you know, I took a detour. I'm a farmer, but I took a detour through Merrill Lynch for a decade, long story. One of the things I want to own, my mentor at Merrill once said to me, because I came to finance, very long story, came to finance with this impact bent. I didn't have the words, but that was my instinct. And my mentor said, you know, Dana, you'd get your feelings hurt a lot less if you stopped wanting people to do things for the reasons you want them to do them. Just build the vehicle, make it possible, control the rules of the road, and then whether your capital's motivated or not, you don't care. And so I feel that way about, just pulling on the same thread of the example, the mortgage-backed pools that we're talking about. We still, as philanthropists, make sure that they're indexed as affordable to the borrower at the time of origination, because that's what works for low-income people. And we make sure that they're amortized over a full 30-year ammo, because that's what works for low-income people. So you're still in there building the vehicle to control for the impacts. But you're leveraging the capital. And to the earlier panel, some of your investors are motivated by the same things as you, and some of them are not. And you know, maybe it's because I've been in the field and I feel like a bit of a sellout at this point, but I don't need them to honor the shrine of affordable housing is great anymore. I'll just move their capital.
So maybe, Brian, if I can jump in there. So I totally agree with everything that Dana just said. I think we similarly are focused on how do you create the right environment to crowd in these investors, whether they're leading with an impact lens first or not. I think maybe the approach we've taken is a little bit further down in kind of the product development life cycle, where we're using, again, our flexible resources to fund very early stage kind of product incubation and development that can hopefully speak to the risk return requirements of those private investors to move them against the SDGs and SDG aligned impact in a credible and scalable way. And so this zero gap portfolio that I mentioned earlier that MacArthur has supported us on, that's both a grant portfolio, so we have 50 different grantees of all these different financial products and solutions that we're trying to incubate and get out into the market. As those products move through the development life cycle, we now have this investment fund that can give target investments to anchor them to then hopefully lead to a scale up where other both mission aligned and mainstream investors can come into the mix. And so we're using our philanthropic flexible funding to play the same role that Dana described in terms of creating new product, new mechanisms, perhaps just in a different way, and obviously not off our endowment's balance sheet, but a very similar approach in that we want to make ourselves irrelevant in the products we're creating over the long term, and it's all about having that sustainability in mind when you're structuring products. And just one last thing I'll say about this is our ability to be credible, because you mentioned this, credible with the private sector partners we're trying to engage with is absolutely paramount. And we've been one of the ways that our team has been able to do that, I believe, is we're SDG agnostic, we're sector agnostic, we're geography agnostic. We're literally looking for the best, most compelling, well-structured ideas that can bring scale and innovation to the space of trying to close this SDG financing gap. And I think that's led to a lot of creative products that we've been able to work directly with the private sector on that wouldn't have come our way if we simply said we have these three sectors and that's all we can do.
Just on that, one of the big criticisms or concerns that people raise always when you talk about catalytic capital is the threat of market distortion, as if we have totally free markets now. There's not already market distortions, but that by having objectives other than fiduciary, profit maximizing in a risk-adjusted context, having anything other than that leads to picking winners, distorting markets, subsidizing failure, and so the danger is not that you might not crowd in commercial capital, but crowd out commercial capital that says, ooh, you said that you built IIM to look and smell and touch like a traditional asset manager. So sometimes the smell of having philanthropy behind you might turn people off, right? So
Sure.
Do you ever encounter that?
Absolutely, and I think it goes to kind of the intentionality that you're going into in structuring these products and structuring these deals. If you have this kind of sustainable goal in mind when you're creating these new products and structures.
By sustainable, you mean?
I mean private sector can run with this
Right.
product on its own.
That the impact is embedded and that people that don't care about impact would look at these deals and want to invest in them.
Ideally, yes. And so it's about, I guess I would say, the responsible use of catalytic capital and making sure that you're right-sizing your subsidized tranche or your concessional tranche or whatever support you may be providing in a way that is not going to distort the market. And do we always get that right? No. But is it worth the risk of getting a new product out into the market that can mobilize private capital at scale against these issues? Yes. And I think that's the determination we've made. And I think you'll see plenty of kind of projects and deals in our portfolio that have done a really good job of getting that kind of balance right, and others that have gotten it totally wrong. And that's all part of the learnings that we're undertaking. But as long as the gap remains, and you have, based on our latest math, around $5.3 trillion in sustainably aligned capital already out there. We have $5.3 trillion that's already committed to this space over here, and we have a $2.5 trillion financing gap over here. It seems like there's ought to be a way to bring that together, and that's where the catalytic capital comes in to kind of bridge those worlds. And so our priority is to get that bridge right, and how we build it is different based on the sector, the theme, the asset class, but that's the idea.
And Kate, do you, in your support for the entrepreneurs within your network, what are their biggest challenges that they're facing? And I assume it's not market distortion, because we're talking at the maybe earlier stage of the product development of these companies. But is there, what does success look like for these entrepreneurs?
Yeah, and just to the market distortion piece, we're addressing a market failure. I mean, there just isn't money at this level and spread to reach the diverse set of people who can be entrepreneurs, who can create the companies that then down the road others can invest in. So I think that's really important, which goes to the main problems our entrepreneurs face. And I'll just give you, my own example. I just spent last week driving all over upstate New York, from Buffalo to Syracuse to Binghamton, just to understand this ecosystem, developed economy, very different than on the ground in Uganda. And still, the only money available is NYSERDA and state economic development money. It's the only money available, and at every step, until way down the road from an entrepreneur's perspective, it is a struggle for the best companies out there to find available capital. My program in New York is focused on not this kind of first in, which is most of the Nexus, but I'm trying to do the gap between the traditional sort of Series A growth capital, where you have proven tech and you have a good team, you have customer uptake, but you don't have the capital to scale it. And energy in general is just something that has been a tough place to invest. It's capital intensive. The returns have a long horizon. That's why government has traditionally gone in and played a role. And I think that as we face the climate crisis, we're going to need to be solutions oriented. We think that the solutions are going to be generated by a broad set of entrepreneurs all over the world, who are tailoring solutions. It's a fantasy to think that there's going to be a silver bullet and a one-size-fits-all approach to this. We're going to have a really broad set of solutions tailored to local needs, and we need the capital at the ground to build that up.
It's going to take a lot of energy.
That's for sure.
So with that, we're going to not have Q&A. I just got the signal. So with that, please join me in thanking our great panel.